All right, so let's circle back. In order to predict future share prices, we have two different sets of patterns to identify and use and make forecasts for. So one set is the real data, the accounting data. So that it's mainly sales, earnings, profit margins, and assets. So these are the real data for the company. It's when we try to understand what the company is doing, how it's creating value, and not least how it's growing. So we identify patterns, and we can make this in chart form. So you just plot out historical data, and then you extrapolate that into the future in a way that looks the least surprising as possible. So an outside person looking at your chart should not be able to easily guess where your predictions begin and where the historical data ends. So if it looks the least surprising possible, then it's a plausible extrapolation for the company's actual fundamentals. So there's one set of data and patterns that you need to identify and use for predictions. The other set of patterns that you want to analyze and use for predictions is the valuation multiples. And this is a bit of a different story, because valuation multiples, they tend to, over time, to gravitate toward a market average. So a single stock might grow very quickly, or it might have a certain profit margin trajectory that mimics other companies in similar phases in history. But when it comes to valuation multiples, over time, as companies grow bigger and slower and become the average of the market, then their valuation multiples also gravitate toward what is historically normal and average. In any case, the way we model future valuation multiples is by looking at cyclical variations historically for that very company and for similar companies in history, because that tells you something about how the market usually appreciates and values a certain type of company. So those are the two main patterns we we break the price down into these two components. We identify the patterns separately, we make predictions for both, and then we combine them, factoring them together in the future in order to come up with our price predictions. And then as a third independent estimate of future stock prices, we simply look at the prices themselves, because they also establish patterns. And the patterns they establish, they typically depend a lot of herd behavior, group psychology, market herding, where investors tend to flock to various corners of the market or to certain companies at certain times in history. Right now, for example, recording this in early 2025, the Magnificent Seven, the super large tech companies, they are attracting all the interest. So money is flowing into them, and that is creating certain price patterns. It can be very steep exponential price curves followed by steep withdrawals due to risk off and a certain risk aversion due to maybe exogenous risks and factors like war or a Fed interest rate decision and stuff like that. So this creates a certain type of share price patterns that repeat over history. And by analyzing just the price performance, completely agnostic of what's happening in the real economy, there is some information as that as well, because the total group, the community of investors, they are informed of and they are affected by what the absolute highest price paid has been for a stock and typical bottoms that have recurred over and over again, maybe pointing to a certain valuation level where more investors are willing to put money at risk in that company. And this creates somewhat reliable repetitions in terms of market of pricing patterns. So you can both analyze fundamentals and valuations, but also independently the actual prices themselves. And when you combine these, you can arrive at valuations that give you the certainty and the patience and the ability to use time as your advantage. That means that if you buy cheaply enough, you know that if you wait long enough, you will get your money back. But if you pay highly enough, too high, then you will never get your money back, at least not on a risk-adjusted or real basis. And then on top of that, you use pricing patterns to try to improve your timing a little bit, so that you can deviate from the idea that the market is always right. Because as we discussed earlier, if there's one thing we know, is that sure, the market might always be right in this very moment. You know that the only price you can get by selling at the market is at the current bid price by the best bidder. That is what it means that the market is always right in this very moment. But we also know that market prices tend to vary by plus hundreds of percent and down to a fourth or a fifth of the current price, even for very established and large and profitable companies like Meta platforms. So we know that market prices will change much more than fundamentally warranted. And this is what we want to use for our advantage, but also use for improving our market timing. Because even if we knew that Facebook was very cheap at 200 after falling from 400, there was still a risk that it would fall to 100 and even a little bit below, which it did. And sitting through that 50% drop in value from 200 to 100, that is so painful that most professional investors might be out of their job before the turnaround comes. And then it doesn't matter if it goes 7x in a couple of years, which would be a heroic performance for any investor. But you just don't have the ability to sit it out. You might, as a private small investor, because you don't have anybody to answer to except yourself or maybe your wife or your husband. But usually the reason we see these extremes, the extreme peaks and extreme troughs, is because market psychology and your own psychology, it creates an urgency, a fear of losing or a fear of missing out that makes you that makes most people sell at the worst times possible and buy at the very peaks, because that is what's creating the peaks and the bottoms.